back. This is Hunter Wells with Preferred Financial with Mark Wells as well. Today we will be talking about the first-time homebuyers programs. There's several of them out there, and one of the main things, if you hold on till the very end, we will tell you how you would be able to use those programs without actually being a first-time homebuyer. So,
That's right. Yeah, there are a number of incentives in the mortgage industry for first-time home buyers, and that follows just a general policy that's always been an American dream to own their own home, and the benefits of owning a home versus renting. Basically, you're going to have to pay money to live somewhere, so you may as well be paying on a mortgage and have an asset that will appreciate with general appreciation, and that you'll pay off over the years, and hopefully when you get ready to retire, you don't have a house payment anymore. So there are a lot of first-time home buyer programs specifically designed for first-time home buying, and then there are regular programs that we find are very useful for first-time home buyers. So we want to cover all of that.
I think one of the biggest thing that kind of helps generally is just the lesser down payment with these programs. Instead of having to do a 5% down like you would on a conventional, some programs go as low as 3% down, which doesn't seem like a really big difference, but it quite literally comes out to thousands of dollars that you save with having to bring to closing. So as Mark mentioned, there are several incentives when coming into buying your first house. There's plenty of different programs within plenty of different areas, such as conventional with 3% down, FHA. There's a lot of first-time homebuyer incentives, and that is what we will be talking about today. And just kind of to start out, did you want to start with conventional loans and just go how?
I think what I'd like to cover is just the general barricades that most first-time homebuyers have to get over. And a lot of the first-time homebuyer programs are designed to address those difficulties. And one of those, as you mentioned, is down payment. Probably the single biggest hurdle to home ownership is the accumulation of down payment. So this is where the homebuyer programs, first-time homebuyer programs, allow for less down payment. They also allow for down payment assistance, which we'll talk about. But there are many aspects of the first-time homebuyer programs that help. That's probably the major one. And whereas a standard borrower who is not a first-time homebuyer is going to need to put 5% down minimally to get a loan, first-time homebuyers can do as little as 3%. And again, depending on your income, it can even be as small as 1%. And then a first-time homebuyer can take advantage of other outside means of down payment assistance. So we find that down payment is the biggest hurdle. The second biggest hurdle is credit. And not always that there's bad credit, it's just that credit scores build over time, and they build as you build your depth of credit, which means the number of credit accounts that you have had, and also how long you have had them. That is the reason that for the biggest part, if you're young and have a very limited number of credit accounts that you've established with a shallow payment record, meaning you just haven't had them that long, you may be fighting some score barricades, but again, the first-time homebuyer programs are designed to help that situation. So down payment, credit, those are the big boosts that come along with the first-time homebuyer programs.
I think something that's important to talk about is just why do you have to give a down payment when buying a house? One of the main things and one of the main reasons that lenders require a down payment for a house is so that you have money in the transaction. Now, they've looked at decades of statistics, and they found that at about a 95 loan-to-value ratio, meaning you have 5% with your 5% down in down payment, they find that the default rate lowers right at that kind of sweet spot. So why is down payment so important?
It is a risk factor. It's an enormous risk factor. The truth is that your grandparents, when they went to get a house, they had to put 20% down payment. That was back in the 30s, the 40s, the 50s. You couldn't buy a house without 20% down. The reason for that was that if a house ever goes into foreclosure and the bank takes it back, they have to sell the house to recover their money. And history has shown that a distressed sale like that will not bring the full market value of the house to the lender. And generally speaking, a house that has been foreclosed on and put back on the market is not in as good a shape as other homes because it probably got neglected before it went into foreclosure, and then it hasn't been maintained for the period that it took to foreclose. So generally the houses are devalued by their condition, but they also get devalued by the fact that the public knows that it's a distressed sale. The bank is trying to get out from under a bad situation, and so people who make an offer on a house like that are going to make a lowball offer. And historically, lenders only recover about 75 to 80% of what the house would have sold for had it been a regular sale that was not distressed. So that was the original reason for the 20% down payment, but that was also, if 5% is a big barricade, you can imagine what 20% was. It took families years and years and years to accumulate the down payment where they could own a house. And again, because of government incentives and general policy incentives, there was a move towards how do we lower the down payment. And what happened was, and this is interesting because I was actually in college with a girl whose father started the first PMI company in the United States. And the PMI company, which you may have heard PMI, it's private mortgage insurance. It doesn't insure you, the buyer, against anything. It insures the lender that in the event of a foreclosure and a default on your loan, if the lender sells your house and does not recover all of their funds, the private mortgage insurance company pays them their losses. Generally, what happens if a house goes into default early in its history with a particular buyer and the house sells for 80% of what it's worth, but they had loaned 95% on it, the PMI company will make up the lost 15% to the lender. So PMI became a tool by which at first it allowed people to make a 10% down payment. And then as they perfected that insurance model, 5%, and now that they have continued to perfect it, they know how to allocate risk to a 3% loan. But as you said, the less money a person has in their house, the less skin they have in the game, and the more likely they are to walk away when under duress or distress. Whereas if you had put 20% of your own money in it, you would probably find any way you could to hang on to it so that you don't lose that 20%. And it's just that dictates default statistics. So the first-time homebuyer programs also have, in some of the cases, what we call a supplemental PMI, meaning that they aren't charged the actual PMI premium that it would normally take to insure a 97% loan. That's actually because of other incentives to the lender to make loans to first-time home buyers. The PMI is less expensive than it would be just in the regular open market.
Yeah, so one of the main points of these kind of talks are to just kind of pull that curtain back because it is a big market. And
It is.
As you mentioned, what are a few of those lender incentives to make those types of loans?
So let me kind of start with FHA. FHA is not a first-time homebuyer program. Anybody can use it. The only restriction with FHA is if you are currently living in a house where you took out an FHA loan, you cannot buy another house with an FHA loan until you sell that house. You could not retain a house to rent out and buy a new house and have two FHA loans. But apart from that, there are no income restrictions on FHA. It's not technically a first-time homebuyer program, but what we find in practice is by default, mainly because of lower credit scores, it can often be the best program to use for a first-time homebuyer. It has a much lower credit threshold. We have been able to book some FHA loans down to even 595 scores. Conventional loans have a hard stop at 620 or under, but realistically, we don't get a lot of conventional loan approvals between a 620 and a 640 score. It's more when you get over 640 that conventional begins to become viable. So FHA can address a number of issues. For instance, if you've had a bankruptcy filing in the past, the waiting period after the bankruptcy filing before you can buy a house is much shorter with FHA. So it can become a go-to program. The other secret about FHA and why it works so often is that on FHA loans, PMI premium is not determined by your credit score, whereas on a conventional loan it is. Meaning the higher score you have on a conventional loan, the lower your PMI premium is. Sometimes we have two borrowers, we have a borrower who could go either way, and we simply put the two programs side by side and say, okay, the FHA rate is this, the conventional rate is this, but the conventional PMI is this, and the FHA premium is this, and we just find out, okay, where's the best payment? And in general terms, if your credit score is 680 or under, probably FHA is going to be the way to go, even if you're not a first-time home buyer. But for first-time home buyers, it's quite often the default program. The incentives that are built into the conventional programs are mainly government-led incentives that say to the lender, we expect you to meet certain housing affordability guidelines. We know your business is lending money to homeowners, but we want to encourage first-time home buyers. So they incentivize from a tax standpoint and from a regulatory standpoint for Fannie Mae and Freddie Mac, who are the conventional gateways, to include in their general loans that they are making on a monthly basis a certain percentage of loans that were made for first-time home buyers. And that's why Fannie Mae developed the Home Ready and Freddie Mac developed their Home Possible programs.
I think one of the big pieces is, it sounds like it's perfect, but when you compare, again, FHA versus conventional, we have to remember that your mortgage insurance will be on the lifetime of the loan for FHA. Whereas when you get about 20% of equity in your house and you have that 20-80 split, you're able to wipe away that mortgage insurance.
Yeah, and we're going to cover all of the pros and cons, but where FHA is normally the go-to, it does have the feature where PMI never drops. Conventional does. So if we've got those two loans side by side and you say, well, I'm only going to be in this house 3 to 5 years, well, it really doesn't matter. Because you're going to drop PMI on a conventional loan in less than 5 years usually. But if you are buying a house that you think you're going to be in for 20 years and the conventional loan and the FHA loan have similar payments, well, you're going to want to go with the conventional because you will be able to drop the PMI premium when you develop the 20% equity. So we'll talk about those pros and cons because ultimately both programs have advantages and both of them have disadvantages.
So I kind of want to run through a scenario because it is a lot of people just out of college with their first jobs. And in your experience, what program have you typically used for people who are in a position of looking for their genuine first home? They have some established credit, not the best, they're just trying to figure things out. What have you found has been the best policy or the best?
It's highly tailored and highly individual to where you can't really say that for a college graduate or a high school graduate, okay, this is going to be best because first of all, the conventional first-time homebuyer programs have an income restriction. You cannot make above a certain threshold income, and that threshold income is determined by the zip code that you're buying in. So it's different all over the country, and that makes sense. If you're in San Francisco where the median house price is $800,000 and the average income is $150,000, you don't want a $60,000 income threshold for the whole country, and those urban areas would be left out. So the first thing we determine from a new application of a first-time home buyer is what is your qualifying income. That may totally eliminate the Home Possible and Home Ready conventional programs altogether, because if it's a good thing to make too much money, but if you're making too much money for the program, you can't use it. And in that case, we might default back to FHA, again, because of some of the strengths that involved with FHA. Then we might look and say, well, okay, 3.5% down on FHA, but you said you're going to be here 10 years, so maybe we should look at a conventional loan with 5% down that we can get rid of the PMI. And it becomes choices, and what I like to do more than anything else is to lay out for the individual borrower the actual choices in hard numbers so that they can see for themselves and explain what the pros and cons are, and then they can fit the program to their own plans rather than my trying to fit them into a hole or into a peg that I think they should do. I like to just have the whole picture, show the options, and say, here are your options, here are the pros and cons, and let them make that decision.
And I think giving the borrower the power not only gives them choice, which is always a good thing because they can make their own decisions, it also is just a good informative.
It is.
Because they'll be buying a house later on down the line and they'll know, well, there are multiple loan options out there.
Right. And mortgages, like any other industry, the mortgage industry has its own terms, it has its own definitions, and it can be massively confusing. I always say to people who come in who feel like they're asking too many questions, they apologize for, I'm sorry I have so many questions, and I just tell them, if I had to go over to your job today and do your job, I would have 1 million questions. And there's nothing wrong with questions. You need information, and that's what we try to provide, because you can't make an informed decision if you don't have the right information. So that's our goal. And we try not to ever slot anybody into anywhere just because it's a cookie cutter and it's worked before for somebody else. We want to make sure it works for the individual in front of us. So let's talk about maybe some comparisons of the programs that will give you an idea of what we look at if you come to us as a first-time home buyer. First thing we're going to ask about is a down payment. Have you saved any down payment? The great thing about these programs is that if you have not and you have zero down payment of your own earned and saved funds, all of the programs, FHA and the conventional, allow for the down payment to be gifted from a near relative. Near relatives are defined as anyone in your extended family out to a first cousin. We also have gotten exceptions for registered godparents. You can't just make up that you have a godparent, but if you have a church record where you had a godparent stand in at your baptism or confirmation, or you have anything like that, they are considered also a family member and can gift you the down payment. There are sources from which your down payment may not come from. One of those that we run into still sometimes is cash. Sometimes people put cash in the jar to save a down payment. There's nothing wrong with doing that, and it's perfectly okay to do it. But most of these programs do a 60-day look back at the point you apply for your home loan, and they say how much money was in their account within that 60 days. And if you all of a sudden throw cash in and you can't trace that money because you can't trace cash, then it is not a legitimate source of down payment. Now, the reason for that is to prevent fraud. So, for instance, there's people that cannot participate in your down payment. One of those participants is us. We're the lender, or the broker, we're going to earn a commission off of your loan. We cannot take some of our commission and give it to you. That's an illegal source of down payment. The seller cannot give you any down payment. The realtor involved with you or involved with the seller cannot give you money just to get a deal done. So the reason that lenders are so strict about tracing where the down payment comes from is that they want to prevent loan fraud. Also, unfortunately, cash is how money is initially received when it's going to be laundered. So there are, illicit and illegal transactions, drug transactions, where giant amounts of cash are generated. And so part of the provision that cash cannot be documented for down payment is to prevent money laundering. But apart from that, there are some other, those other sources that I mentioned cannot be used for down payment. Anyone that has a financial interest in the transaction itself cannot give money to you. But down payment can be received from a gift, from a relative, from a near relative. There are also, if you meet the low income requirements, there are median income figures for every geographic zone. There are 80% of median income makes you eligible for some down payment assistance programs. There are also certain trades and jobs that have down payment assistance programs. One of those is emergency responders. That would be firemen, policemen. There are programs for nurses. There are programs for EMS. These are down payment assistance programs, and sometimes the assistance is either a grant that you are given the money for the down payment, and as long as you live in the house for 5 years, you don't owe it back. If you sell the house in less than 5 years, you have to pay that back. But you can use down payment assistance programs with all of the first-time homebuyer programs. But the main difference as we stack them up between FHA, which is a go-to first-time homebuyer program, and the conventional Home Ready, Home Possible programs, the biggest differences have to do with the PMI structure. FHA PMI is structured with two components. It is structured with a 1 3/4% charge for what is called the upfront PMI premium, and that amount is financed into your loan. So if you had, I'm going to use easy numbers, if you had a $100,000 loan for an FHA purchase, your FHA upfront premium would be $1,750, and that $1,750 would be added to your loan balance. So whereas initially it looks like you're borrowing $100,000, technically you're going to borrow $101,750. That increases your payment slightly, but it also takes up some of your equity that you would normally have, because with FHA you put 3.5% in, but basically you're getting half of that taken back in equity by the upfront PMI premium. None of the first-time homebuyer programs that are conventional programs have an upfront PMI premium. Now, then there's a monthly premium. That is an amount that is added to your monthly payment that stays on the loan differently with FHA and conventional, as already mentioned. If you put 3.5% down on an FHA loan, you can never get rid of the PMI. It is on the loan permanently, and you cannot get it off. With a conventional loan, after you have generated 20% equity in your property, either by paying the loan down over time or by the appreciating value of your home, at the point at which you have 20% equity, the monthly PMI premium on a conventional first-time homebuyer program can go away. In practice, we have generally said that's going to take between 4 and 5.5 years in most markets, with normal appreciation before PMI can be dropped. So again, first-time homes are usually stepping stones to the bigger home, for the bigger family home, and so it may not matter that that you can't get rid of PMI, but that's a decision you have to make, and so that's why we put them side by side. So the PMI structure is the biggest. The disadvantage on the conventional side is that even though the PMI can be dropped, the monthly PMI premium is dependent on your credit score. So you could have the whole situation set up where FHA, you're saying, well, yeah, let's go conventionally, but then you have maybe a 640 score and your PMI is double what it is on an FHA loan.
And then it's not going to matter.
And then, yeah, then you say, well, you know, even if I pay that for 5 years, I'm better off with the lower PMI that FHA has, even if I can't get rid of it at the time, because other than that, I'd be paying an extra $75 a month for 5 years on the conventional PMI.
Yeah. And I think one good point to mention is that, you know, if you choose to go with the FHA program and you have that PMI that remains on the lifetime of the loan, and you get into your first house and you just fall in love with it and you never want to move.
You don't want to move.
You're able to refinance.
Yeah. You can always refinance to a conventional loan down the line once you have the 20% equity.
So you're really not stuck with anything. There are options, and you know, we can't really determine the future. Now we can try to expect things and try to be in a bigger, better house later on down the line, but a million things can happen between now and even when you get to that 20%. I mean, that's 5.5 years. A lot can happen. You might have to move.
And that's a good point. Yeah, I always tell people that we don't know tomorrow. We don't know next week. And the best we can do today is make decisions on what we know today. And that may not turn out that way, but you can't go back and question why you made that decision. You could only use the information you had at the time. And you're never stuck in any housing situation. There are refinance possibilities, you know, and there are many things that you can do if your plan doesn't go exactly the way that you thought it would.
Kind of just like a safety net at the end of the day. I mean, if you get in a situation where you either don't want to get out of the house or can't really get out of the house, you can just do a refinance, which we found that we can we can do a no cost to a low cost refinance, which basically, depending on where the market is and depending on where the numbers are, we would be able to, you know, refinance for about what your monthly payment would be.
Right, and you skip a monthly payment when you refinance, so we pay for the refinance with the skipped payment.
Yeah, so there's plenty of options, and it's not like you are stuck and you are kind of left behind, and you know, you can always make good of a situation regardless.
I want to mention two things, just one real small quirk about FHA. If you put 10% down on an FHA loan, I probably only had a handful of borrowers do that in 30 years. But if you did put 10% down on an FHA loan, the PMI is no longer life of loan, but it is still 10 years before you can get it off. That's one of the things. I want to talk about two programs that don't normally come into play under a first-time homebuyer discussion, but they're great first-time homebuyer programs. One is VA. VA loans have no down payment. 100% financing, and that's for military veterans with honorable discharges who have served 4 years in active service or 6 years in reserves or have served in a combat zone. An eligible veteran can buy a home anytime, first time or not, but it's great for first time home buying because there's literally no down payment on a VA loan. Another program that we will talk in more detail about at some other time is USDA. That is a Rural Development Authority loan that is designed to, it's a 100% loan. You don't have to be a veteran. Anybody can use a USDA loan as long as you don't make above a certain income level, again, for the zip code that you're buying in. But that if you're buying a property in a designated rural zone, according to the U.S. Department of Agriculture, you can use the USDA program. And it's an excellent first-time homebuyer program because, again, it has no down payment.
So just to kind of sum up a lot of the things that we've talked about, we have plenty of different programs that we've listed. There's a lot of advantages, disadvantages, pros and cons about whatever you may be looking into. And one of the things with the stuff that we had mentioned, such as down payment assistance programs, that is something that we have to verify. So kind of talk about that a little bit.
Yeah, as far as the programs themselves, it would probably save you a lot of time and effort to just give us a call or reach out by email and allow us to just screen for you the programs that you would be eligible for. It's great to research all of these things for yourself and to know it, but we can compile it in a way that would save you hours and hours of surfing the internet trying to find out. In regard to the down payment assistance programs, those programs are run by different government agencies and sometimes different nonprofit agencies, and they are available, as we mentioned, according to your occupation, according to your income. We can let you know that you are within, for instance, an income eligibility for down payment assistance, or you are in a trade or business or profession that allows for where down payment assistance grants can be used, and that we can couple those with the programs that are first-time homebuyer programs that allow for it, and put the structure together for you. Applying for down payment assistance is a separate process from applying for your loan, but you don't necessarily need to go out and apply for the down payment assistance first. You can come to us, we can pre-approve you for the loan, give you the tools you need to go apply for the down payment assistance if you're going to use one of those programs, and make that process a whole lot simpler. Again, you could spend hours only to find out, well, I don't really qualify for that particular down payment assistance. We can help on the front end, but when it comes time to do the loan, you will apply for your loan with us in one place and apply for the down assistance, which will help you coordinate, but that will be done with the entity that's making the down payment assistance for you.
So to just further summarize everything, we've talked about the 3% down, home ready, home possible, right?
Right. 3.5% down FHA.
Yeah. And as mentioned before, we've been talking about first home buyers programs, but
Oh, that's right. We have to tell you how you don't have to be a first-time home buyer to use a first-time home buyer program. As always, the devil's in the detail, but little rule that comes to play in there that's not always well known, but if you have not owned a house in the last 3 years, then you can use a first-time homebuyer program even if you own 5 houses in your lifetime.
Yeah.
And sometimes those are lifesavers, for the particular place you are in life. And we always ask these questions when we do our initial interview with you over the phone. Where have you lived? Have you rented? How long have you rented? Those kind of questions, because we know if we have someone who has not owned a house in the last 3 years and yet there's a mortgage on their credit report that was paid off 4 years ago, well, hey, you're eligible again for the down payment program, and it may be very beneficial to go that direction, even as a non-first-time home buyer.
I just find it funny that they labeled it first-time buyer programs, even though you don't have to be a first-time buyer program.
Which is why we like to help you navigate. There are all these little exceptions to everything.
Yeah. So as always, please feel free to leave any questions, comments. We encourage you guys to call in with any concerns that you may have, or if you're wanting to just start the process, or if you've already done it and you need some clarification on things. We love hearing from you guys. So anything that you may have, any topics that you may want us to cover, please just feel free to reach out. We are located at 311 Pettigrew Street in Greenville, South Carolina. We service all of South Carolina, and we do have some ties into North Carolina and Georgia as well. So you can reach us by phone. It is 864-235-9596, and our emails will be listed in the description.